Assalamualaikum and hi, my name is Nur Ashiki binti Muhammad Ali from class 3G, and today we will present to you about our project regarding tax planning.
Hi, my name is Ahmad Haikal bin Khairul Nizam.
My name is Nurhuda binti Jamal.
My name is Siti Nurnadia binti Ismail.
Hi, my name is Sayyidatina Umi Kalthum binti Said Omar from 3G.
Today, I am the first presenter who will present question 1 regarding the possibility of merger of Zack and Well under one company. State your argument for treating the manufacturing and distribution of biscuit as a single sources as well as two separate sources of business. State the tax implication for both cases. If Zack Sendirian Berhad and Well Sendirian Berhad combined under one single sources of business, the capital allowance within the company can be fully utilized. Any unabsorbed capital allowance of 700,000 can be carried forward to future years to be set off against the same business income provided that the business income has not ceased permanently. Only the same manufacturing sources can set off the unabsorbed capital allowance from the manufacturing business. If Zack and Well were treated as separate sources of business, the capital allowance is to be charged against each business. Capital allowance will be limited to income from each sources. Capital allowance on Zack of 700,000 cannot be utilized against adjusted income of Well and vice versa. In order to fully utilize the capital allowance within the company, it is always tax efficient to structure various business activity to be one sources of business income rather than two sources of business. Hence, Zack and Well should merge their company under one single sources of income. However, if any of the business incur losses in the current year, these losses can be set off against the aggregate income from all business sources, and if there is any unabsorbed losses, the amount can be only carried forward for a maximum of 7 consecutive years of assessment, and this can be applicable for both single and separate sources of business. For a single business sources, the adjusted loss will be treated as part of the gross income. However, if Zack and Well are separate sources of business, any of the business incur losses in the current year, these losses can be set off against the aggregate of the statutory income from all business sources. Since both companies may be deemed to have separate sources of income, then the current year adjusted loss of Zack amounting to 300,000 in the year assessment of 2019 cannot be treated as part of the gross income.
Today I want to present question B, which is about whether the company should acquire machine by leasing or by outright purchase. So firstly, I want to talk about acquisition machine by leasing. Number 1, company is a lessee, which means the company is not the owner of the machine. Number 2, company is unable to claim capital allowance since the company is not the owner of the machine. Number 3, the lease payment is deductible against adjusted business income and it treated as a business expenses. So it will increase adjusted business loss if company do not have income for the current year, and it can be carried forward if not fully utilized. And number 4, no restriction on lease payment, which means the lease expenses will deduct business income as long as company lease the machine. Second, acquisition machine by outright purchase. Number 1, company able to claim capital allowance on full cost of machine. 20% for initial allowance and 40% for annual allowance, which is company able to claim capital allowance every year until the full relief given for that machine. After that, there is no capital allowance can be claimed anymore. Number 2, the company will be the owner of the machine at the end of the payment. So, I strongly advise company should choose acquisition machine by leasing, so tax liability will be minimized and it gives the most advantages to the company.
So now I will present on question C, which is interest restriction. For interest restriction on loan under section 33 sub 2, provide that taxpayer has borrowed for the purpose of producing business income, the deductibility of the interest paid on borrowed money will be restricted based on the formula. If investment is equal or more than borrowing amount, the whole amount of interest is non-deductible. Meanwhile, if the amount of investment less than borrowing, only a portion of the interest is deductible. Since a loan given to Profund is borrowed from financial institution, so the amount of investment and borrowing is same. Hence, the whole amount of interest, which is 10%, is not deductible. Besides, in order to expand its business, Profund had to borrow money from ZAC and had to pay 6% of interest. Therefore, the interest on loan is deductible against business income. This is because the amount of investment is less than borrowings. The amount of interest restricted will be added back to arrive in adjusted business income. And the amount of interest restricted would be allocated to individual investment source. If the restricted interest cannot be offset against income of the related investment, the excess interest expenses cannot be carried forward and would be permanent loss. So here, apart from that, there are some measures that should be considered to overcome the interest restriction problem. Number 1, identification of investment or advance funded from existing borrowing and direct allocation of the cost of borrowing to the investment or advance. 2, review interest charge annually, source for cheaper financing. 3, arrange for the subsidiary associate company to borrow directly from the bank. 4, establish separate bank account to hold specific loan monies exclusively for business use. 5 is create sufficient non-business income to absorb interest applicable to investment. 6, disposal of investment that are not profitable to pay off the borrowing with high cost of fund. 7, withdrawal of fixed deposit to settle the borrowing.
So, I will present the question D, which is tax planning on disposal of fixed assets. Before the company dispose the asset, the company should know which company should they dispose the asset, which are related company or unrelated company. In this question, the related company is Reni Sendirian Berhad. If the machines are disposed to this company, the machineries are deemed to be transferred at the residual expenditures of the asset. Due to that, there will be no balancing allowance or balancing charge. Since it is a control transfer between their subsidiaries, then the disposal value will not exist and Reni Sendirian Berhad will continue the same capital allowance as Z Sendirian Berhad. Apart from that, if the company disposes the fixed assets to the unrelated company, then the machineries will be transferred at the disposal value. The disposal of machineries will be result in balancing charge or no balancing or allowance. Then the disposal value will be at the selling price that has been agreed between the company. Furthermore, the acquirer of the asset will be claimed the capital allowance based on the acquisition of the price incurred. Therefore, Z Sendirian Berhad should dispose the machineries to the Reni Sendirian Berhad, which a related company. Since it will give rise to a huge loss on disposal of the asset, as the assets have a very low residual value. Since it is a control transfer, the disposal price is deemed at the residual value. Hence, resulting no balancing charge and balancing allowances occur. Therefore, the possible rise in loss on disposal will not affect the company tax liability, since the low residual value is being used as the disposal price, which is disposal price equal to residual value. The fixed assets in this question is lorries. In general, any fixed asset disposed within 2 years, the tax authorities were empowered to claw back the capital allowance that has been claimed in previous years, and it will be treated as balancing charge in the year of disposal. So, this will increase the tax liability of the company. Since the acquisition of the lorries of Z Sendirian Berhad is within 2 years, so in conclusion, Z Sendirian Berhad is advised not to dispose the lorry within that years. This is because to avoid the clawback of capital allowance. Before Z Sendirian Berhad dispose the lorries, Z Sendirian Berhad is advised to hold the ownership of the lorries for more than 2 years, because this will help the Z Sendirian Berhad to minimize the tax liability of the company.
Today, I will present the answer for question E, which is the group relief loss and show the computation. In the question, we have 4 related companies which are Zack Sdn Bhd, Profile Sdn Bhd, Rainy Sdn Bhd, and Well Sdn Bhd. In order for companies to be eligible for group relief laws, they must be related companies. Next, we have to identify which company will be the claimant company and which company will be the surrendering company. In order for the company to become a claimant company, the company must have the aggregate income, which is in the equation we can see that only Well Sdn Bhd have the aggregate income for that year of assessment. On the other hand, Zack Sdn Bhd, Rainy Sdn Bhd, and Profile Sdn Bhd will be the surrendering company. Next, we have to compute for the total income of the surrendering company. So this is the total income for the surrendering companies. Since they earn adjusted loss for that particular year of assessment, their total income become nil. Then we have to compute for the group relief loss surrendered by the related companies, which is 70%. But we have to notice that one of the surrendering company, which is Profile Sdn Bhd, cannot surrender its current year loss to the claimant company, which is Well Sdn Bhd, because the company is currently enjoying the investment tax allowance in the year of assessment. So this is the computation for the group relief loss surrendered to the claimant company. Next, we calculate the chargeable income of the claimant company, which is Well Sdn Bhd. We need to deduct the loss surrendered that had been calculated against the defined aggregate income to get the amount of chargeable income. Thus, the income chargeable to tax of Well Sdn Bhd being reduced to 270,000 ringgit after deduct the group relief loss by surrendering company.
Lastly, I will present question F. This question discusses whether Zack Bhd should acquire Jack Bhd by share acquisition or by asset acquisition. Our group answer is yes. Zack Bhd should acquire Jack Bhd by share acquisition because number 1, Zack Bhd can utilize unabsorbed capital allowance or unabsorbed business loss of Jack Bhd to be deducted against any business income of Zack Bhd and vice versa since they are one company. And any capital allowance or business loss can be carried forward if not fully utilized. Number 2, plant and machineries that are not fully claimed capital allowance, company can continue claim capital allowance since there is no disposal of the plant and machinery. Number 3, any return on investment that Zack Bhd receive will be dividend income under single tier system. So, the income will be exempted from tax. And number 4, generally the transfer of share between Zack Bhd and Jack Bhd will not be taxable as share is capital in nature. However, if it RPC shares, it will be subjected to real property gain tax, RPGT. Zack Bhd also can apply for exemption under Para 70 Sub 1 of Real Property Gain Tax Act 1976 and Section 15 of Stamp Duty Act 1949 if the acquisition of share or asset are in connection with scheme of amalgamation of reconstruction and the consideration comprises substantially of shares in transferee company. That's all from me. Thank you.